Okay, so let's dive a little deeper into this accounting equation and look at how it kind of reacts to different transactions. And we'll kind of do some transactions, keep a running tally, and hopefully by the end of the video, I'll have proven to you that this symmetry between the left side and the right side always holds true. Okay, so before I do that, let's just recap on uh, the accounting equation: assets equals liabilities plus equity. And I stated that this is where all the action is happening. Okay, the equity, the assets are pretty straightforward. You know, you're gonna have cash, land, equipment, the balances for that stuff. You're gonna kind of know who you owe money to with your liabilities. Equity has two distinct kind of components: the contributed capital. So this again is how much the owners of the company have contributed to the company, and we have retained earnings. So the owners of the business, their value is one, what they've actually put into the business out of their own pockets, and then two, how much money the business has earned, basically, right? So how much profit has the company generated? That is going to kind of accumulate to the owners. Now, the retained earnings, remember, is profit, as I just said, revenues minus expenses. But then we also had minus the dividends. So a company may be very profitable where their revenues exceed their dividends. Sorry, their revenues exceed their expenses, but then they're going to pay all that out to the shareholders. So even if this profit here is large, even if this is large, if you're paying it all out to your shareholders, it's going to kind of cancel each other out, right? So the retained earnings, so both of these words are important. Earnings, which is how much profit the company generates, and retains implies that it has not dividended that profit out to the shareholders, right? So how much has it retained in the business and reinvested in the business, right? So you can either use the cash that the company generates in profit to pay out a dividend, or you could buy more machinery, more real estate, more investments. You can use that profit to reinvest in the business. So this is kind of at the discretion of management, whether they want to return that profit to the shareholders in the form of dividends, or if they want to reinvest that profit back into the business. And so the higher this retained earnings balance is, that implies that more of the profit has been reinvested in the business. Okay, so again, keep that in mind. There's two kind of branches of equity: how much the owners have contributed, and this is again in the form of common stock, and the retained earnings is once the business is running, how much profit has it generated and kept in the business. Okay, so now let's look at some transactions and see how this accounting equation balance changes. Okay, so this first transaction here, we're gonna raise $100,000 by selling stock. So this is basically we're going to investors and we're saying, hey, give us $100,000 of cash and we will give you some ownership interest in our company. Okay, so um, again, we have kind of assets equals liability plus equity. So after this transaction, we're gonna have cash of 100K. That's an asset. So on the left side of our equation, we have $100,000. Now, this selling of stock, we're not borrowing the money, okay? We're giving ownership interest, okay? So the liabilities, this is from people who have lent uh, money to our business who are expecting it to kind of be returned to them in a kind of set amount of time. Like when you go to the bank and you get a loan, they're like, okay, you're going to pay me some interest, and then you're going to pay back the loan within a certain amount of time. when you issue stock, it's a perpetual kind of trade where the owners are giving up the money, but then they have this interest in the business as an owner in perpetuity. Okay, they're not expecting the money to be returned by a certain set amount of time. So we didn't borrow this money, so our liabilities are zero. And now we have some contributed capital. Okay, so um, we're gonna have $100,000 of contributed capital in the form of common stock. Now, if we were to break this down into accounts, we're gonna have cash equals 100K. That's an asset. And then in our common stock account, we're gonna have 100K. But common stock is gonna be on this side, and the cash is going to be on this side. So we can see here that the equation is balanced. There's 100K on the left side, and there's 100K on the right side. Okay, so now let's go to this next one where we pay utilities $500. So we're going to have to reduce our cash balance because remember, we're going to use cash to pay off the utility company. Okay, so this cash balance is going to go down because we're going to write a check to PG&E or whoever our utility provider is, and they're gonna take money out of our account. So the cash on the left side of the equation is gonna go down to 99,500. Okay, so what's gonna happen to the right side? So we still haven't borrowed anything, and I'm gonna kind of break this out. I'm gonna have contributed capital plus retained earnings. Okay, so remember, equity is kind of these two components together. So I still have $100,000 that I originally sold in common stock as my contributed capital. Now, what is retained earnings? This is revenue minus expense minus dividends. Okay. So what this $500 is basically an expense. Okay. It's this thing that has happened in my business. Not getting any future benefit. It's utilities, electricity, gas, whatever I've already used. And so we're gonna have to account for that as an expense. Okay, this is something that my business is paying for because it's used up this value and it's now gotta create this expense for it. Okay, so um, if we fill in the numbers here, we have zero revenue minus $500 and we haven't paid any dividends. So this is zero. So when we do this math, you can see here that it's basically 100K minus $500. So we have 99,500 equals 99,500. So we're still balanced. Now we're going to buy artwork for $10,000. Okay, so we're going to pay cash and we're going to get this artwork. Now the question is this an expense or is this an asset? Well, hopefully, just through watching the other videos and reading the chapter, um, you've determined that artwork is an asset. Okay, we have this thing that we own. It's worth something, and so our business is going to treat it as an asset. It's something that we own. It's not something that we kind of it was like a one-time expense and it's just kind of gone. We could that art has some value, okay, and we're going to have potentially a future benefit from it. So we're going to hold it as an asset. So it's going to go on the left side of the equation. But now kind of this is why we have accounts because we have cash is going to go down 10,000. So it's going to be 89,500. But now we have this other asset called art, which is worth 10,000. So if we combine these two, basically we're going to have the same balance as this. Okay, because these two assets combined are 99,500. Nothing happened on the right-hand side of the equation. Okay, there's no change in our liabilities. There's no revenue. There's no expense. And so the right side of our equation is exactly the same as it was above. It's unchanged. So you can see here, we basically swapped one asset for another. That's why this didn't change. The total amount of assets is unchanged, even though we traded cash for art. Okay, so um, this was one key thing that we determined that art is not an expense. It is an asset, and that we're trading one form of asset into another. Okay, so we can still see here that our equation is balanced. Okay, so the next one is kind of a trick question. Let's say some time goes by and we determine that the artwork is, we think, estimated to be worth 500K. Now, is there some event that we can kind of account for here? Well, not really, because we haven't transacted. We think it's worth 500K. We don't know that for a fact. Um, until we actually sell it. Okay, so if we don't sell it and we're just speculating that it's worth 500K, there's no transaction. Okay, we're gonna just leave this. The balances are essentially going to be the same. Nothing's changed here. Okay, so this is the case that we just estimate that it's worth more, but we haven't actually transacted. Now let's say we do sell it. Okay, we sell it for 500K. So what happens to our balances? So the cash balance is going to go up 500K because we sold it. It's going to be 589,500. Art is now zero because we sold it. Okay. So that's going to be kind of the asset side of the equation. And then what's happened on the right side of the equation? So we can have this, sorry, 589,500 equals no liabilities. We still have the 100K in contributed capital, which is their common stock. Now we have some revenue. Okay, we generated this sale, this gain, basically this cash transaction of 500,000. So we can have 500,000 of revenue minus $500 from that utility expense. And you can see here that this balance is also 589,500. Okay, so hopefully you're now becoming convinced that throughout the process, every transaction, we're gonna maintain this balance between the left-hand side and the right-hand side. Okay, so now let's say we buy a vehicle for 20,000. So I'm gonna kind of undo this. We'll assume that we didn't really sell it and we just have these balances here, of which basically cash 89,000 and this art was 10,000. So now we're going to have three assets. The vehicle is also another asset. So we're going to have cash now going down to 69,500. We have art, 10,000. And now we have vehicle, 20,000. And so again, you sum this up and it's still the same, 99,500. Nothing has happened on the right-hand side. We still have um, basically the 100K in contributed capital minus zero revenue minus $500 of expense and then no dividends. Okay, so this is just another example of trading one asset for another. Okay, so now we provide some service to our customer and the customer pays us cash of 5,000. So our cash is going to go up by 5,000 to 74,500. Our art is still the same, 10K. Our vehicle is 20K. And so when you add this up, it's just going to be basically 5,000 more than this. So 104, 500. And then what's happening on the right-hand side of the equation? No liabilities, 100K in contributed capital still, minus, sorry, add our profit, which is now we have revenue. Okay, we've just generated $5,000 in revenue. We had that $500 of expense for utilities and no dividends paid. And so if you add all this up, we have 104, 500 on the right side equals 104. Okay. So the only new addition here is that we had this revenue here. Okay. It appeared in this equity section of our accounting equation because remember, this is revenues minus expenses. Okay. This is essentially the definition of profit. This is your profit, also called earnings. These are all kind of synonymous. So remember, this entire thing is called retained earnings, where you have the earnings minus whatever you paid as a dividend. Yeah. So um, just trying to restate what I've stated before to just make sure you're getting it. Okay, so now finally, at the end of the year, our vehicle is not worth $20,000 anymore because we've used it up. We know vehicles lose value. So we have to somehow account for the fact that this vehicle is being used up and it's worth less. Now I'm introducing kind of a concept we're going to cover in much more detail. What do we call this? Where we basically we have to reduce this value. We're going to have to take an expense. We've used up some of this 20,000 that we put up to buy the vehicle. We're getting some value out of it and it's reducing in value and that's essentially an expense to our business. Okay? So we have to expense the usage of this vehicle and the loss in value. So we call that depreciation. Okay? So we're going to have a depreciation expense. And let's just say we estimate that the vehicle has used up $5,000 worth. Okay. And we're going to go into much more detail on this depreciation topic later, but I'm just going to give you the number. Let's just say depreciation expense is 5,000. So what is going to happen? So this is not going to affect our cash. It's still 74,500. Our art is not affected. The vehicle, though, we're essentially saying is worth $5,000 less now. So it's only worth 15K. Okay, so now we would add this up. The total is 99,500. Okay, so now what do we do here? We have not borrowed anything. We still have 100K in common stock that first transaction that we first engaged in to sell common stock. Now let's look at the retained earnings. So this is the contributed capital. And again, this entire thing from here to here is our equity section. This is the liabilities. This entire part is our equity. Okay, so we had one part of equity, which is contributed capital. The other part is retained earnings. And so we had $5,000 of revenue from this number 6 here. Now we have $5,500 of expense because we have this new $5,000 depreciation expense. And then we had that utility expense from before. So our total expenses are 5,500. We did not pay a dividend. And so when we do this math, we get to 99,500. And we can see that this symmetry is still maintained. Okay. So hopefully stepping through these transactions, um, you've gotten convinced to some degree that this accounting equation is balanced throughout every transaction. And it is the case, okay? As we go further in the class, I think you'll become more convinced of this. And really, at every point in time, this accounting equation of assets equals liabilities plus equity, it's always going to be balanced. Always. Okay, it's always balanced. And in fact, one of the kind of king financial statement when you're gonna present what's going on with your business to your financial statement readers, the balance sheet, as we call it, the balance sheet is going to be dated usually at the end of the year. So let's say 12/31 of whatever year, and you're going to show as of this day, at the end of the day, what are the balances? How much do you have in cash? How much do you have in land? So cash, land, vehicles, da 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 da. You're going to list out all your assets. Then you're going to list out all your liabilities, who you bank loan, bonds, whatever it is. You're going to list them out. You're going to list out your contributed capital. So this is equity. So you'll have on one hand your common stock. I'm just going to abbreviate it CS, and then you're going to have your retained earnings, and you'll basically have numbers for these. You'll add them up. It'll be whatever 100. Maybe your total liabilities was 20, and then the total of your equity section is 80. And you will see that this equation will hold. And you're going to prove that to your financial statement readers by presenting this balance sheet. Okay, so we're going to talk about the financial statements in a later video, but this is a prelude to it. All the financial statements are actually going to be also derived from this assets equals liabilities plus equity. They're just kind of components of it to show the details. Okay, so but we'll save that for a later video.